So the previous year was quite interesting and lots of volatility. What was the high and low points too?
The low point was probably the volatility around the Liberation Day, end of March, start of April. But the higher points, of course, that we came back to normal levels, as you always do.
Yeah.
These kind of market turbulences tend to be short-lived and temporary in nature. And once again, we got evidence that if you are a long-term investor, you should just stay the course.
Yeah,
Everything will go back to normal eventually.
Exactly. Welcome to Sifter Fund's annual review. It was quite a year again. The year started with a nice rally in January, but then in April, Liberation Day came and all the stock prices went down roughly 20%, 25%. The other themes in this year were AI and data center investments, but also geopolitical tensions, which were increasing, unfortunately. Let's take a look at the Sifter Fund's 5-year performance graph, and let's compare it to the world index. What kind of observation and conclusion you can make from this 5-year investment horizon?
Well, first of all, the 80% cumulative return has been pretty good, and that's probably above normal historical levels as well. There has been two different time segments that you can look at. The first half of this graph shows you the Sifter Fund doing a lot of outperformance, especially compared to the MSCI Global Index. But in the other half, we can see that the index is starting to catch up, probably due to the fact that quality as a theme has not been that hot, especially in 2025. Quality has drastically underperformed the value style and growth styles of investing.
But we started to see signals of rotating back to quality end of the last year, and now in January also we have seen some positive rebounds. So let's see if it continues.
Well, it's a good signal that the quality style of investing is now relatively cheaper than other styles of investment, as mentioned before. So that bodes well for the years ahead.
Yeah. And let's take even longer perspective. Sifter Fund was established in 2003, so already 23 years ago. We can see that we have been able to return roughly 700% gain in 23 years. And that is 80 percentage points more than an index. So is that a good, or how would you evaluate that kind of outperformance?
Well, it's evidence that our strategy of finding growing quality companies tends to be the right one.
Of course, we would like to provide even more excess returns to our investors, but on the other hand, we don't like to take extra risk like investing in hyper-growing companies or some thematic topics. We rather stay very focused on these quality businesses with predictable earnings, which are growing year after year.
And it is within our circle of competence as well.
That's correct. Let's go deeper into this previous year top sector and worst sector. So which was the best sector in the Sifter Fund, and which companies include in that sector?
So the best sector, both for the fund and for the world as a whole, was the communication services segment. This consists of our investment into Alphabet, Universal Music Group, and also for the first half of the year, Walt Disney Company. But from the Sifter Fund point of view, all of this outperformance from this segment came from Alphabet, because that had a fantastic year in 2025.
That's correct, and we will dig deeper in that company later. Technology as a sector was the second best, and it was very close to these communication services. But which one was the worst industrial sector in the portfolio last year?
Well, on the flip side, we have the healthcare sector, which was partially driven by our investment into Novo Nordisk, which we will talk about later, which had a lot of trouble in this year. But it's also driven by the fact that the Inflation Reduction Act by President Biden and the most favored nation policy by President Trump are two major new regulations or incentives that aim to reduce the prices of pharmaceutical drugs in the US. So there has been a lot of pricing pressure for all the pharmaceutical companies in the US, and a lot of volatility as well with regard to tariffs.
Okay. Well, let's dive deeper into the top contributors in the fund and which were the drivers behind those top contributing stocks. First, we have Lam Research. It's clear winner, 110% share price gain in 1 year. Then we have Alphabet and then thirdly, Safran. But let's talk about Lam Research first. If you think about a company which doubles its market cap in 1 year, there must be some interesting things going on in Lam Research, or what's your take?
Well, to understand the performance of Lam Research, we have to go back to the year 2022. This is in the aftermath of the COVID pandemic, and a massive shortage of chips is ruling the world. In order to solve this shortage, a lot of money was spent into building out chip-making capacity in the world. And Lam Research is the company that sells these machines with which you are making semiconductor chips. So it's like an investment good. But in fact, these investments were so massive and so large that we came into a period of oversupply for chips, especially memory chips. So from 2022 to 2024, there was an overabundance of chips, and therefore not many new fabs were built, and therefore Lam Research would have had a slower year if it wasn't for the fact that these AI chips started to dominate and again lift the company's prospects. And indeed, in 2025, the demand for AI data centers becomes so large that this oversupply of chips was not just depleted, but went into a stage of deep shortage. And in the fall of 2025, the spot prices for memory 5 doubles in just a few weeks. So we are today at a screaming deficit of memory chips. And that's, of course, why Lam Research has been doing so well, because the market is now discounting that Lam Research will see a lot of new orders for chip-making equipment in the next few years.
What kind of trade actions we have taken in previous years regarding Lam?
Well, we know Lam Research quite well. We know it follows typically a 4-year investment cycle by its customers. So from our point of view, as the share price went up quite a lot last year, the price to risk to quality ratio went down. So at the end of this last year, we decided to ease our exposure to Lam Research. So we sold about 1.5% of our stake, percentage point of our stake in Lam Research.
So quite minor stake.
Yes, we are still heavily invested into Lam Research, and the reason for that is that even though we know it's a cyclical company, there's reasons to believe that this current upcycle might be even stronger and more persistent than the ones in the past. There's some clear early indicators that this might be the case.
Okay, very interesting. And moving to second best contributor last year, that's Alphabet. And Alphabet, it's now the second time in our yearly annual video because last year, 2024, it was also the top performer, but it has faced difficult times or at least threats. We know that there was this potential AI threat, and then we had the other one that was the
antitrust case.
Antitrust case, exactly. So something good has happened to Alphabet in previous years. Can you go a bit deeper behind those two topics, AI threat and antitrust?
Well, the AI threat is related to the fact that these new novel large language models would kind of change the user behavior in how they find information. And in other words, they would not be Googling stuff anymore in the future. And that's the core business of Alphabet. This has not happened, or at least is not really visible in the business model of Google. The advertising revenue for the company has been unchanged over the last year, and in fact, even accelerated a bit towards the end of the year. Maybe because Google's own AI models are better able to understand the user's intent and is therefore able to sell even better targeted high-value ads for the user. So the AI threat seems to be overblown. The other risk factor was, of course, this antitrust case in which the worst case scenario could have been that the company would be broken up into smaller parts. But that ruling came in early autumn, and it was basically not a big deal. The company is not going to be broken up.
So one could even argue that AI threat is nowadays AI's strength for the Alphabet.
Well, that's a good point, because Alphabet has launched their own models. They have for some time already, but the latest Gemini model launched this last fall are indeed currently the best ones in the world. And Google might have an edge in making these next generation models because they have access to such data sets from users and YouTube, which could allow them to make models that no one else can replicate, given the access to the same kind of data.
So what's your view on Alphabet at the moment, and are we going to increase, decrease the position? What do you think?
Well, last year when we had the same discussion, we decided to increase our stake into Alphabet because back then it was a very attractively valued company. Today the valuation has more moderate levels, but given the fact that, of course, we got the AI models, which are tailwind for Google, we have the Waymo self-driving car tech, which is now coming to Europe. We have the cloud service segment, which is also growing at a very fast rate, even also accelerating. And we have the company's other DeepMind AI stuff as well, and YouTube. So basically the business is firing fully on all cylinders at this moment. So given these kind of facts, the current valuation is still quite reasonable. And that's why this is currently our biggest investment that we have in the Sifter Fund.
Yeah, that's correct. Well, our third strong performer last year is a European, or even more especially, it's a French aircraft engine manufacturing company called Safran. It's an industrial company. How is it possible that an industrial company can provide such a nice over 40% share price return in 1 year? Is there something going on in Safran?
Well, from where I'm sitting, there's nothing special going on. It's just business as usual. Safran makes aerospace engines for aircraft, which they get a lot of revenue from the service and maintenance of. And it's very much linked to the global level of airline traffic volume, which has now recovered from the pandemic lows and is now growing at a stable rate of 3 to 4% over year by year.
Yeah.
In addition, the backlog for a new aircraft airframe is over 8 years long. So we have a really good understanding of what kind of revenues this company can generate in the long term. But I think perhaps the one thing that has a little bit boosted Safran more than normally this year is the fact that European nations' defense budgets have been increasing, and there's been a new demand for avionics sensors, part of which Safran manufactures and sells as well. So it's kind of a little bit of defense spending as well, which has been boosting the company's outlook.
Yeah, and Safran is one of the heaviest holding in the portfolio at the moment as well, like Alphabet.
Indeed. Funny enough, these 3 outperforming companies here are also the top 3 companies in the portfolio.
Yeah, and then we have Microsoft, which is also one of the heaviest one. Well, those were the top performers. So let's look at the bottom performers. Unfortunately, we also had those. We have Novo Nordisk, West Pharmaceutical Services, and Old Dominion Freight Line. So let's talk about Novo. We have discussed Novo several times in 25. We had a profit warnings, then we have a CEO kick out, the board composition was changed, and then we had a problem with the compounding pharmacies in the US. Could you elaborate and go a bit deeper which one of those problems are still up and running and which ones are something that are already passed away?
The last year started with even more data about the next generation weight loss drug, which is called CagriSema, which kind of indicated that this drug is not going to be meaningfully better than what the competitor currently has on market, which will make it harder for Novo Nordisk to defend their market shares in the future. On top of this compounding problem has continued this year. As a background, in 2024, there was a shortage of weight loss drugs in the world, which are also used by diabetics, and therefore the FDA had this exception that compounding pharmacies could make their own version of the drugs temporarily. This exception officially ceased to exist in May 2025, but these compounding pharmacies decided to kind of interpret this law a little bit differently, and thus they have continued to do large-scale compounding of semaglutide throughout this year. And the company's poor reaction to this problem, which took a lot of market share from Novo Nordisk, is the reason why the CEO was fired alongside with the majority of the board. So indeed, there has been a lot of negative things, almost a perfect storm for Novo Nordisk in 2025.
Well, how do you see if those risks and situations are well known? So how do we see the future, this 26 and maybe 27 and further? Do we see any positives? And we are still a shareholder of Novo, and as we can see in this graph, we have increased our position a little bit. So what's the reason for that increase? And we must be a little bit positive.
Sure, there's always been a few positive signals this year, especially towards the end of the year. First of all, we got a new CEO and we got a new board of directors that has together made a new and aggressive strategy to defend future market share for Novo Nordisk. In addition, Novo Nordisk revealed data for the pill version of Wegovy. So a pill version of this weight loss drug that had good data with a good safety profile and was approved by the FDA for sale at the start of 2026. So this is the first time in the world that we have a fully functioning, safe oral weight loss drug. So these two factors combined with the launch of CagriSema sometimes next in the early 2026 are positive signals of better things to come. Indeed, Novo Nordisk is a bit of a turnaround case, and we believe that the worst has now happened and that the future will be more rosier in the case of Novo Nordisk. And especially at this newer and lower share price, we thought it was a good idea to increase our exposure to the company.
Okay. The second bottom performer is also from pharmaceutical sector. It's not a drug manufacturing company, but it's a subcontractor for pharmaceutical companies. So it's a West Pharmaceutical. Tell me a little bit about the West business and why the share price took a nosedive in early part of the 25.
So West Pharmaceutical Services, they make this kind of small rubber component for drug delivery mechanism. So we can think about a syringe or an auto-injector. Really this rubber component, quite simple product, but they have very high standards of cleanliness and performance, which make them somewhat valuable for the company. But this year started with a very poor earnings report in which the kind of company leadership signal for slower growth ahead. And the reason for this is that in the past, the company has seen a lot of good growth from vaccines related to the COVID-19, in which these rubber components were very prominent and quite valuable as well. But as anyone can imagine, this is not a sustainable long-term business. And in fact, this has to be replaced by some other types of revenue, mainly in the form of biologic drugs like Novo Nordisk semaglutide, for example, and the auto-injectors, which also use these rubber components. But what the management failed to kind of mention or really underline is the fact that these rubber components for biologic drugs is not as high margin as the market has thought. And this disappointment became obvious at the start of this year, which is the reason why the share price went down quite heavily in the year.
So what was our action after that?
Well, naturally, we had to take a new look at the company. So we made a new deep dive to really understand, is the investment hypothesis still correct for this company? Does this company have the ability to grow with good margins in the future? And the outcome of that is, of course, we had to adjust our expectation a little bit downwards. But given this new and much lower valuation of the company, the price to risk and quality ratio was pretty good. And indeed, the company does have long-term growth opportunities. It's not a dead business by any mention.
Yeah.
So for that reason, we decided to increase our stake to West Pharmaceutical.
So it was a good decision, at least in the short term. We can see that it has rebounded a little bit from the low points.
In the short term, we can see that the subsequent earnings report has been correct and in the order of magnitude that we had expected for the company.
Right. Well, our third decliner is a US-based logistic company called Old Dominion, and a share price went down last year. What kind of headwinds Old Dominion has faced, and is the business model or the underlying business deteriorated last year, or how do you see the Old Dominion case?
It's just a problem of the end market. So Old Dominion offers less than truckload services, so essentially transportation services, mainly geared toward the United States. And tariffs uncertainties and just general poor manufacturing activity have been a persistent headwind for the company in this year. and it's not just related to aluminium, it's a sector-wide issue. Now, in cases like this, aluminium will take out their playbook on how to handle a slowdown in the end market. And what that playbook says is that keep investing, do not lay off any people. Because they know that in the long term, eventually the market will rebound. There will be more demand for the service again. And if they keep their investment high, then they have the capacity to take market share from competitors that are cutting down on their services in the downturn.
Yeah.
And this is the model that aluminium has been running for the last 30 years or more. And that's the reason why we like this company. They have a really long-term shareholder value thinking mindset.
Yeah, it used to be family-owned business, and we like that kind of culture where they have a long horizon in their business and they know what they are doing.
Indeed.
Yeah.
And for that reason, we decided to take advantage of this lower valuation and increase our stake to aluminium.
Couple of times, yeah. Well, those were the top and bottom performers last year. Let's review the portfolio changes we took last year. We had a roughly 80 sell or buy transactions, which is quite on average for 1 year. The portfolio rotation is still quite moderate or even low, roughly 10% per annum. So we are not actively trading. We are a long-term investor for a quality businesses. If we look at the companies we sold, we have Autoliv, Disney, and SMC Corporation from Japan. Is there some common theme for these 3 companies we exited?
The common factor would be growth, and growth, really. Or in other words, the lack of long-term growth opportunities.
Right.
So in the case of Autoliv, they are making safety equipment. Think about seat belts for mainly Western car and automotive companies. And is this a booming sector at the moment?
No, I don't think so.
No. Indeed, the Chinese are doing quite well, but they don't have a much exposure to the Chinese auto car makers. So indeed, the long-term growth opportunities for Autoliv is very much tied to the European automotive sector, which is not very favorable at this moment, or maybe not even in the future.
Yeah. How about Disney?
For Disney, it was basically not following our initial investment hypothesis, at least to the degree that we had expected. So Disney, of course, in the past made a lot of money from the cable TV business with the Disney Channel on ABC, but that's, of course, a long-term declining business, which must be then recovered by some other new business venture, which was supposed to be the streaming segment.
Right.
Our thesis was that the streaming segment will be growing a little bit faster. They would reach economics of scale that would improve the margins in the long term as well, because it's a very scalable business to have a streaming service. But the competition within that segment was still pretty high. There has been the expected consolidation that we had hoped for. So indeed, Disney has not been able to achieve the level of growth for the streaming segment that we had anticipated. And for that reason, we decided to then sell the entire stake. It did not follow our investment expectations.
Yeah. And the SMC Corporation, it was a minor stake, minor holding, so anything special there?
Not much. They make pneumatic components for heavy industries, and that's kind of a old-fashioned segment that's not really growing that fast anymore, and there's some signals of Chinese competitors that are further hindering long-term growth opportunities.
So then we reallocated money to new 3 companies. We introduced new companies, Cintas, IDEX, and MSCI. So what is there a common theme for these 3 new companies?
Well, there is one common theme in that none of these companies are really driven by artificial intelligence, if that's what you're looking for. Indeed, Cintas it's a uniform rental company in the US for the heavy industries mainly.
Yeah.
And they have a nice little niche in the fact that they are the biggest company by far, and their competitors tend to be smaller local companies with poorer economies of scale, and therefore Cintas is able to deliver a more cost-efficient service. And therefore they are continuously taking market share from these smaller competitors year after year after year.
Right.
And that's why the company has been able to increase earnings by roughly 10% per year over the last 10 years.
Well, that's amazing from an industrial company.
Indeed, and we can expect that to continue as well in the future.
Yeah. How about IDEX? We also have a video in our website of IDEX, but what's your, in a nutshell, why IDEX?
Well, in a nutshell, IDEX makes these blood analyzing machines for the veterinary industry.
Like a diagnostic.
Diagnostic tool, exactly, for dogs and cats, which of course they cannot speak, they cannot tell you what's wrong, so you have to take a blood sample or some other sample to understand what's wrong with them.
Okay.
And IDEX has this nice little niche that they have the majority of market share in these blood analyzers.
Yeah.
And they get recurring revenues from these blood samplers that the veterinary industry will have to buy for every time they take a new blood test.
How about the business KPIs for this kind of business, roughly?
Well, it's still growing roughly 10% per year. It has this recurring revenue element from these consumable parts. So again, it's kind of similar profile as the Cintas. It's a stable, growing company.
High gross margin, high return on invested capital.
Yes, the measurements are quite in order, in line with the fund as well.
Yeah, okay. Anything special about MSCI as a company you would like to highlight?
Well, the nice part of MSCI is that they are, of course, the flagship product is the global or the world index, to which every global fund and most global ETFs are linked to. So they get a small slice of every dollar spent on a world fund, which is the fastest growing team of investing, if you will. So that's a really, really nice business that is generating quite a lot of revenue.
Yeah.
In addition, it had this upside from trying to benchmark now also private assets, so infrastructure, real estate, and private equity funds, which in the past doesn't have this kind of well-defined benchmark index, but MSCI is trying in the future to be the provider of an index for those kind of assets.
Yeah. From business quality point of view, I would argue that Cintas, IDEX, and MSCI are better businesses compared to the ones we sold, Autoliv, Disney, and SMC.
Yes, and that's in line with our model. We are comparing business models to each other and try to continuously make the business KPI for the portfolio as a whole better.
Yeah. Let's review the portfolio diversification at the end of 25. On this graph, we can see that the geographical exposure in North America is roughly 65% of the whole portfolio, which is still underweight compared to world index. The Europe is overweight, roughly 28%, and Japan and Asia developed is quite minor part of the current portfolio. But if we look at the midsection, meaning the sector allocation, so we have technology and industrial sectors, which are the biggest ones in the portfolio at the moment. So why do we have technology and industrial companies, and what kind of businesses we have, for example, in technology?
Well, the reason why these are so prominent in the portfolio is that these kind of sectors does have the long-term growth opportunities and the durable and sustainable moats that we are looking for. So good companies, good quality companies tend to be overrepresented in these two sectors. The technology sector consists of our investments into Microsoft, which is a software company, but also our semiconductor company, Lam Research, which we have talked about today, and also TSMC, which is utilizing Lam's equipment to make chips. So indeed, it's a very broad category ranging from software companies to semiconductors.
So we are not a technology fund at all. I mean that we have companies which are included in this sector, but some of them are more industrial, like building machines, high-tech machines, so to say.
Yes, and indeed our industrial exposure is also quite large, as we can see. We have Safran, which is an industrial company which makes the aerospace engines. We have a new company like Cintas and Old Dominion, which are also represented in the industrial sector, along with companies like Atlas Copco. So indeed a quite well-diversified base of investments.
Yeah, I think the diversification is as being a global fund, so I think it's justified to have a different sectors. But as we know, we are not exposed in consumer cyclicals or real estate or even utilities and energy. Is there a specific reason for that?
Well, there's probably many reasons, but I guess the first and foremost is the fact that it's really hard to find differentiations between companies in these kind of sectors.
Yeah.
So indeed, differentiation and pricing power is one of the key criteria that we are looking for. And in this sector, it doesn't really tend to occur.
Yeah. For example, energy sector, it seems to be thematic at some points. It might be a good performer for a couple of years, but then it goes down again. So we are looking for companies which are able to grow earnings year after year. And typically in technology or industrials, you might find those.
Yes, exactly.
So if we look at the 10 largest holdings, so we can see that Alphabet is the largest one. Then we have an industrial company, Safran. Then we have a couple of semiconductor companies, Lam Research, Applied Materials, and even TSMC. Let's move to the core of the Sifter investment philosophy. It's the key performance indicators, meaning the fundamentals of the business metrics. If we look at this table here, so we can see that the Sifter companies on average increased the sales by 8% in 25. That's quite okay. It's not a super high fast growing company, but it's still it's a good growth. But when it comes to gross margin, it's 54%. So what does it tell to you?
Well, gross margin is a very good indicator of pricing power. If you don't have pricing power, you tend to have much lower margins. 54 as an average for a company is pretty good. It's probably the top decile as a whole.
Yeah.
And of course, this is the average of all of our portfolio holdings.
But at the gross margin, on average, it's been increasing year after year. So is there any specific reasons why now it's the best among 5 years?
Well, the core reason is probably because we bought these new companies like MSCI and IDEX that have, as a nature, they have more pricing power and they have better gross margins. While at the same time, we have been selling these companies that are not performing as well on this specific metric, like SMC and Autoliv typically had quite low gross margins.
Yeah.
And that's the reason for the improvements to that.
Yeah. Then operating income, it's very high. It has remained high and it has increased. Also, return on invested capital is on a nice level, 24 on average.
And so is the net debt to EBITDA metric, which tells you how leveraged the balance sheet is. And on average, our companies are not very leveraged. They are mainly equity financed.
What do you think about the valuation level, EV, EBITDA, and PE ratio? Those are also quite high. Should we be worried about those or how do you see that?
Well, the critique about the PE or EV beta is just a one point in time number that looks at this year or last year's earnings divided by the current prices. And from our point of view, we are always looking forward 5 and 10 years down the line and try to anticipate what kind of earnings the company can generate over that time period. So if you look at that kind of metrics, our companies look quite okayly valued. They are not expensive because they have such sustainable growth opportunities over the long term.
Yeah. So even though they are a bit more expensive than a year ago, the quality of the business is even more better, so to say.
Yes, justified by the future growth, which should be quite well protected because these companies have good pricing power.
Okay. So we have two main objectives as a portfolio manager. One is to try to keep the portfolio valuation on reasonable level. And the second is to make sure that the business fundamentals are intact and to improve those at all times. Now we have reviewed 25, the main actions, top performers and the bottom performers, but let's spend a few minutes to look at 26, year 26. What kind of themes and expectations, Alexander, you have for this new upcoming year?
Well, one can never know for sure what's going to happen, but we can expect that in the United States, they will get inflation under control to more sustainable long-term levels. And that in turn should put a negative pressure on central bank interest rates. This will in turn then support investments and activity in the industrial sector in the US, which should increase the profits for companies in the next year. That's one theme that we are especially hoping for, the revitalization of the manufacturing industry in the US and also in Europe. We can also anticipate a quite divisive moment in 2026 with regards to the semiconductor server investments, which have been really large in this year and will be even greater the next year. In this year, I think we will get an answer to whether or not these investments will be profitable in the long term or not. We should be getting some kind of early data indicators that will either justify or not justify these kind of investments for the long term. And that, when we get that information, will cause a lot of volatility.
Yeah.
So I think volatility will also be a prominent theme in 2026.
How about geopolitical tensions?
Well, it was pretty bad in 2025, but I think it's going to get even worse in 2026, unfortunately. And that as well, alongside with growing protectionism, should be benefiting some industries and others not so much. And of course, another source of high volatility to be expected from the political spectrum as well.
So in conclusion, I think Sifter is back on track, meaning that our companies are well positioned for 26 and even further. I really enjoy that we have a high exposure in industrial companies where the valuations are lower, and whenever there's more activity, industrial activity, either in US or Europe, they will enjoy a nice rebound. But let's see how it goes. And of course, a strong disclaimer here: this is not an investment advice, but more like a insight what we've been discussing and how do we feel about the companies we own and how the Sifter Fund could perform in the future. As a friendly reminder, please remember that these investment cases we have shared with you are only examples of how we manage Sifter Fund. Those are not recommended as any kind of action or advice to sell or buy any securities. Thank you very much, and let's wish a very good investment year.